Good afternoon, everyone. My name is Ryan Conlon. I am an Associate Director at ETC Tax, and today I'm going to talk about the taxation of crypto assets. So, in particular, what I want to talk about today is the personal tax implications of holding crypto assets and cryptocurrencies. So I'm going to look particularly at the income tax and capital gains tax, really focusing on capital gains tax, and also touch on some other issues arising from these assets. The crypto asset market, so we're talking about assets such as Bitcoin, Ethereum, has developed over the last 10 years, and as the graph I've put on the screen shows, really took off in 2017, spiking, as you can see on the graph, toward the end of 2017. So as a result, if you're an accountant or a tax advisor and preparing tax returns for 2017-18, you may have had clients who realized quite significant gains in that tax year because of the surge in the prices. In terms of what actually are crypto assets, well, as I've said here, there's no widely agreed definition, but broadly what we mean is they are cryptographically secured representations of value or contractual rights that use some type of distributed ledger technology and which can be transferred, stored, or traded electronically. Last year, the Crypto Assets Task Force, which was set up by the government, released a report which made some useful distinctions between different types of crypto asset or different types of token, distinguishing between exchange tokens, utility tokens, and security tokens. And those which we come across probably most frequently are exchange tokens, which we can describe here as methods of payment, including cryptocurrencies like Bitcoin. They are underpinned by these so-called distributed ledger technologies, and their value is based on its use as a means of exchange. We also have others, though, utility tokens, which might provide someone with access to particular goods or services. So a company might, for example, issue a crypto asset, which then can be exchanged for future services. And then we also have so-called security tokens, which might be described as being quite like equity. In terms of sometimes the terms are used interchangeably, crypto assets and cryptocurrencies. Well, as for the legal status of crypto assets, such as Bitcoin as a currency, the Bank of England, for example, does not consider them to fulfill the role of money, or rather only to a very limited extent. And following that treatment, HMRC, when we're thinking about the tax implications here, does not consider crypto assets to be currency or money. In terms of the taxation of these assets, it is really a rapidly developing area, which isn't helped by the existence of some quite complex and confusing terminology, some of which I have made reference to already, such as distributed ledger technology. But it's important that with any apparently new area, it's what you do with the assets rather than the nature of the assets themselves that drives the tax treatment. So although there might not be explicit legislation at the moment dealing with crypto assets, we can draw guidance from existing legislation and case law and the limited guidance that has been published to date from HMRC. So as I've set out here, there is no legislation in the UK as yet which deals with crypto assets, but there are some items of guidance. So HMRC was actually quite early on to publish some guidance back in 2014 on Bitcoin and other cryptocurrencies, and more recently has published a significant paper in December 2018 on crypto assets for individuals, so focusing on income tax and capital gains tax issues rather than business issues. And then following these, they've also included some comments in their manuals, particularly the capital gains manual and the VAT manual. There are no decided cases, to my knowledge, in the UK, but to the extent that EU law applies in the UK, in relation to VAT, the Hedquist case, which was a Swedish case, has implications. But today I'm going to focus on talking about the personal tax aspect, so I'm not going to be dealing with the business issues or VAT issues. Further guidance is anticipated from HMRC on these topics, but at the moment I am not sure when that will be available. I've already said that in working out how we should deal with crypto assets, rather than being thrown by the novelty of them, that we should apply existing principles. So within tax, in terms of working out how it should be taxed, one of the fundamental distinctions here is whether or not an activity, so for example, if someone is buying and selling crypto assets such as Bitcoin or Ethereum, are they undertaking trading activity or investment activity? And here, obviously, when I mean trading for income tax purposes, rather than in the sense that if you are buying and selling some crypto assets, or even indeed if you were buying and selling shares or securities, you might consider yourself undertaking a trade. But I mean trade here in the income tax sense. Trade is defined within the tax legislation as any venture in the nature of trade, which is slightly circular and not particularly helpful. So therefore, to elaborate on that, we fall back on the well-established badges of trade, which were codified in the 1955 Royal Commission. And I'm going to come to those on the next page, but it's important to remember from this Marston and Morton case that badges of trade are not to be considered a comprehensive list of all matters. It's not a tick box exercise, but rather the most they can do is provide some common sense guidance as to the conclusion which is appropriate. So the badges of trade here are listed. So if someone is buying and selling crypto assets, what's the profit? Is there a profit-seeking motive? What's the frequency? Are there a number of similar transactions? What's the nature of the asset, which raises obviously issues for cryptocurrencies and crypto assets? Is there a connection between that activity and any existing trade? Have there been changes to the asset? In what way was the sale of the asset carried out? Were there financing arrangements? What was the length of ownership? And what was the method of acquisition? Now, to the extent that we can draw parallels with other assets, I think the area or the issue which might be closest would be buying and selling of shares or securities and other financial products. And HMRC points this out as well in their 2019 policy paper, saying that the approach to be taken in determining whether it was a trade for income tax purposes will be similar to the guidance which is available in the case law on shares. And I put up here a number of cases going back as early as the 1970s, Salt and Chamberlain, Mansour and HMRC, and most recently Ali and HMRC. The first two cases, Salt and Chamberlain, Mansour and HMRC, the individual involved was held not to be trading. Typically in these cases, the issue here is the reason why they want to be seen as trading for income tax purposes is that they're making losses. And therefore, if they're trading for income tax purposes, those losses can be sideways relieved. So much more valuable losses than if there were capital losses. Interestingly, we had this more recent decision, Ali and HMRC, where it went the other way. And the individual was held to be trading, and what seemed to be persuasive to the court here was that there was a business plan, albeit quite informal, and this seems to have been persuasive. Notably, however, this is just a first-tier tax tribunal decision, so it's not actually binding. So essentially, it's just a reminder here that, again, as HMRC say, it would only be in exceptional circumstances that they would expect individuals to buy and sell crypto assets with such frequency, level of organization and sophistication that that activity amounts to a financial trade in itself. So the presumption, in other words, is that it will not be trading for income tax purposes. However, every situation needs to be reviewed on its merits. Some other comments to make on income tax, where it might be relevant, is so-called mining activity, crypto mining. So crypto assets can be awarded to miners for verifying additions to the blockchain. And mining for these activities, it essentially means involves solving quite complex, challenging cryptographic puzzles, in other words, in order to generate new crypto assets. This gives rise to fees or rewards, and fees and rewards are also received in return for confirming transactions. So in these cases, and if you have dealt with clients who have been heavily involved in crypto asset, you sometimes see receipt of such assets for mining activity. HMRC has stated here that the receipt of these assets will be chargeable to income tax, whether as trading income, if it forms part of another trade, or miscellaneous income otherwise. So in other words, HMRC is saying that income received or of assets received from crypto mining should be subject to income tax, rather than, perhaps they might have been seen as, if I could draw a parallel with bonus issues for shares. So they're not capital, they are income. In terms of determining whether the mining activity is a trading activity, again, you'd have to refer back to the badges of trade. And I think, as I've said here, it would require a significant degree of organisation. One other point to flag up is if the mining activity was trading for income tax purposes, then there might be issues of capital allowances. The equipment that is required for this mining activity is quite expensive, or was quite expensive, in terms of the computing power that is required. So there might be some argument that capital allowances would be due on the acquisition of the assets required to undertake the mining activity, which might then offset any income that would otherwise be subject to tax. Another new term, airdrops. So an airdrop is an allocation of tokens or other crypto assets. So for example, through a marketing or advertising campaign, that are provided automatically to holders of other crypto assets or crypto tokens. Airdrop tokens have their own infrastructure, and these operate independently from any existing crypto assets. That is, they're a different asset. In these cases, HMRC guidance states that airdrops provided in return or in expectation of a service should be subject to income tax, again, either as receipts of an existing trade, if the badges of trade are present, or as miscellaneous income. If they're not in return or in expectation of a service, then they won't be subject to income tax, but there is still a potential capital gains tax implication if they are sold in future. Presumably in that case, they will have a nil base cost. Which moves us on now to chargeable gains. HMRC, having said that it's very unlikely that it will be subject to income tax, says that in the vast majority of cases, individuals will hold crypto assets as personal investments, usually for capital appreciation of its value or to make particular purchases. They will therefore be liable to pay capital gains tax when they dispose of crypto assets. Again, that is in the December 2018 policy paper. In terms of what we mean by disposal of a crypto asset, well, this will include if you sell a crypto asset for money, what we call fiat currency, so something like sterling. So if you sell your Bitcoin for sterling, that's a disposal of the Bitcoin. If you exchange crypto assets for other crypto assets, and I've put this in bold because certainly in my experience it has caught some people out that they were not aware that if they were making exchanges between, for example, Bitcoin and Ethereum, Litecoin, other cryptocurrencies, that those exchanges were themselves disposals for capital gains tax purposes, using crypto assets to pay for goods and services, and also gifting crypto assets. These are all disposals for capital gains tax purposes. As I've said, exchanges between cryptocurrencies will give rise to gains and losses. So it's not simply where there's an exchange for a crypto asset for fiat currency. So where the crypto asset is disposed of for consideration other than sterling, or it's gifted to another person, then it's the market value rule, which is given in section 17 of TCGA. So in other words, it's the price the asset might reasonably be expected to fetch on sale in an open market. Also, the sterling value should be ascribed to the transaction even where the cryptocurrency cannot be directly exchanged into sterling or any other fiat currency. Cryptocurrencies, we already said, are not recognized by HMRC as currency. So where a cryptocurrency is given in exchange for goods and services, that in itself is a disposal of the cryptocurrency for capital gains tax purposes. So the consideration in this case for capital gains tax is the market value in sterling of the goods or services that have been received in return. The market value again here means the sterling price the asset might reasonably be expected to fetch on a sale on the open market. And again, I refer to the 2018 policy paper. Those who prepare returns for individuals who hold shares will be familiar with the so-called pooling rules. The pooling rules apply not only to shares, but to any assets which are of such nature as to be dealt in without identifying the particular asset disposed of. So in other words, assets which are indistinguishable. So if I hold one share in Tesco, for example, or BP or another large company, provided it is another share of the same class, those shares are identical. Therefore, HMRC has, or the legislation provides for the so-called pooling rules. If you are making a disposal, you need to understand which asset it is that you're actually selling for capital gains tax purposes, given that the pool may have been built up over a period of time and acquired for different values. So to work out correctly the capital gains tax position, you need to understand what the base cost is of the asset that's been disposed of. The pooling rules say that when you make a disposal, that asset should be matched to acquisitions of the same asset on the same day. Then it should be matched to acquisitions in the following 30 days, and then only after that matched to what the legislation describes as the Section 104 pool. In other words, that is an average value pool. Each crypto asset forms a separate pool for these purposes. Practical issues that arise from doing this is often, in my experience, the volume of the transactions. We do come across people who have, in one case, we certainly have one client who had more than 100,000 transactions. Difficulties of record keeping often is not as good as those people who might, for example, hold more conventional investments where they have a broker, for example, who produces a nice, neat end-of-year broker pack. And certainly another one to watch out for is for those who have traded quite frequently is the pooling rules, and that it's not sufficient to have details of acquisitions and disposals within the tax year, but really you do have to pay attention to what has happened within 30 days after the end of the tax year. Another new term, hard forks. A fork arises when a blockchain of a crypto asset splits, resulting in the creation of a new crypto asset. I think this is comparable to perhaps the demerger of a company when a company splits into two and creates new assets. So that the new crypto assets for capital gains tax then enter their own pool, and the costs or the base costs need to be split between the two on a just and reasonable basis. HMRC in its guidance says it does not prescribe any particular apportionment method, but it's important to be consistent, and HMRC does have the power to inquire into the apportionment if it believes it is not just and reasonable. While I said at the beginning that there was certainly a surge in value in crypto assets in the 2017-18 tax year, certainly we've had others who have lost money. So as in the disposal of any other assets, it's possible to claim a capital loss where there's been a disposal for less than the acquisition cost plus any allowable costs. Other things to watch out for is potential negligible value claims where assets have lost their value. In these cases, if you are looking at a particular crypto asset and there is a potential negligible value claim, that needs to be with reference to the whole pool of that crypto asset rather than any individual tokens. Other potential issues here, losing public and private keys. Cryptography underpins much of the crypto marketplace. HMRC argue that misplacing the key, if you like, misplacing the password that might give you access to the asset does not itself count as a disposal. But there is still a potential negligible value claim if you can demonstrate that there is no prospect of recovering the password, if you like, or accessing the crypto asset held in the so-called corresponding wallet. There's also instances of being defrauded were quite common, particularly in the earlier days. And again, a reminder of applying existing principles to crypto assets. Theft is not a disposal, since the person who held the assets, although they mightn't have access to them now, they are still the owner of those assets, and therefore they have the right to recover them. So yes, so that's something to watch out for. And the final area I want to highlight was this difference, or apparent difference in position of HMRC's policy statements. So their original guidance published in 2014 saying that depending on the facts, a transaction may be so highly speculative that it's not taxable nor any losses relievable. And there they talk about gambling or betting wins not being taxable. This encouraged some people to believe that the gains, the profits they made from dealing in cryptocurrencies should be taxed, should be treated as if they were gambling, and therefore that no tax was due on them. In the most recent paper, however, HMRC has stated that they do not consider the buying and selling of crypto assets to be the same as gambling, and will not accept this argument. And in fact, I understand from HMRC that their current position is, notwithstanding what they've said in the 2014 guidance, that they have never accepted that profits arising from crypto activities can be treated as gambling. So that's the end of my brief update on crypto assets. I think for most people the message is that it's going to be treated as an investment, and therefore subject to capital gains on any profits that are made, and losses will also be allowable, but only against gains of the same year or future year. I've also flagged up, which may be particularly relevant for some people who have either lost access to wallets or crypto assets, or have been defrauded. In some cases, it might be possible to make negligible value claims. Well, thank you for listening. If you do have any questions, please do feel free to get in touch. And thank you very much.